In this video, we're going to look at credit cards and in particular, just some of the fundamentals. Here are some notes that I'm going to go through, so let's go through those together. Credit cards are used to provide a convenient short-term loan for various small to medium-sized purchases, such as groceries, paying bills, booking a holiday, etc. By short-term, the loan is usually for less than 12 months. Now, it could be 18 months, could be 16 months, but generally when we say short-term, under 12 months is generally the norm. The purchases are generally for items and services worth several dollars, coffee for example, to several $1,000s. However, it is not uncommon to buy items worth tens of thousands of dollars on a credit card, such as a motor vehicle. Compared to home loans, interest rates can be several times higher, so it is not uncommon for credit card interest rates to be in the order of 10% per annum and higher. Some credit card providers may charge over 20% per annum, when the typical home loan interest rate may be 4 to 5% per annum in the same period of time. So we're talking quite high interest, but the loan is for a short term. So if the credit card loan is paid off pretty quickly, it should be payable. It should be doable, feasible. If you leave the loan over a very long period of time, given the very high interest, the interest can build up quite rapidly. So credit cards, and in particular credit card loans, are a type of reducing balance loan where interest is usually compounded daily. Now, when I say usually, it can be compounded weekly, it could be compounded in some other period of time. You need to read the question very carefully. We can't just assume that everything is compounded daily, but that's generally what happens. It's compounded daily, so it's compound interest, not flat rate interest or simple interest, added to the amount outstanding from the time an item or service is purchased. Now, in some cases, the interest charge may be charged on a flat rate, okay, so simple interest, and this will be specified. So if it's not specified, generally it's probably safer to assume compound interest because the interest would in fact be higher with compound interest, so that it tends to sort of build up at an increasing rate. Okay, so but usually it's specified. Now, credit card providers may impose other fees and charges alongside the interest owed. So these will need to be taken into account when determining the repayments. Now, just some other points, I guess, to note. Credit cards are generally more convenient than carrying cash, so it's kind of nice to have a card you can just tap on and off, and it's especially to pay for those sort of smaller items. If you want to get a coffee or some lunch or something like that, it's very convenient, and especially more convenient than carrying cash. Provided the FBOS machines are working and the internet's not down, of course, and therefore cash is definitely will work. But apart from that situation, there's that convenience factor there, especially when purchasing items online or over the phone. A credit card limit or credit limit can be set, which is the maximum amount of money the card holder is allowed to spend using the credit card account. I guess if the credit limits are set very high, I guess it's quite easy to just spend big, build up a massive principal that you have to pay off at 20% per annum interest. That's quite a lot to pay off. So so credit card providers do allow that sort of that setting of a limit. Sometimes it's a limit that they impose based on your financial situation. Other times it can be something you impose on yourself. No, I'm not going to go over $5,000. That's it. That's the maximum. Even though you probably could have a limit of $10,000 or $20,000, but just to sort of control your spending, that's a very handy feature. Statements can be issued, and it's usually monthly, by the card issuer, which provides an itemised record of spending. So great for those sort of tax deductible items or anything that you want to sort of keep track of, especially for business related expenses. Some credit cards have an interest-free period. Now that's kind of very important, and we need to look at that. And I'll look at that in another video, but I might just even highlight that. So an interest-free period, and it's usually 55 days as well. So that's pretty cool. You buy something and you've got 55 days to pay it off. Well, we've got to be careful with that. Actually, I'll clarify that shortly. So you've got 55 days to repay the amount in full where the interest charges on each purchase are waived. Now, how good's that? In other words, as long as you pay on time the balance of the credit card by a certain date, all the interest that would have been owed is kind of wiped off. Great, you just pay just for whatever you've spent. No interest charges. Now, the interest-free period starts from the statement date and not from the date of purchase. Might want to highlight that as well. So it starts from the statement date. In other words, and this is, I guess, a common misconception, and I've got it here in red, in fact, and I sort of put it here at the bottom. A special note on the 55-day interest-free period, and I'll go over this again later. The interest-free time is calculated from the statement date and not from the date of purchase. So you need to look at the top of the statement, whatever the date is on that. So the date issued, the issue date of the statement, whatever that is, you count 55 days from that. And that's when the amount or the balance outstanding is due, 55 days, from the statement date. You've got to pay it off completely. So you could make a purchase a day before the payment date. You don't get 55 days interest free because you happen to spend money on that particular date. It's from the statement date. Again, I'll go over this in a separate example. Now, let me just keep going here. Credit card accounts usually allow a cash advance, and that's basically it's a cash withdrawal. So you can go to an ATM machine, for example, or at a branch or a teller, withdraw some money on the credit card. So it's a loan. Now, interest is usually charged at a higher rate than purchases. Now, you have to be careful with this one. So let's say, for example, a credit card provider is offering a 14% per annum interest compounded annually compounded daily on purchases. But it could be 20% on cash advances, not 14%. So it's a separate interest rate for cash advances, usually. So interest is usually charged at a higher rate than purchase, and interest applies at all times, even during any interest-free periods. So we talked about this interest-free period of 55 days. That doesn't apply to cash advances. You can't just go into a bank and go, hey guys, can I please borrow $1,000 on this credit card? And it's within the 55-day interest-free period. Oh no, that's a loan. They will charge you interest from the moment you take that money out of the bank. Okay? Different to a purchase. A purchase, when you go into a store and you buy goods, that's different. Okay? So we're talking, it's a different situation here. Now, many credit card providers offer reward schemes, such as earning points, so flybys and what have you. That can be used for future purchases, sort of redeeming it for special offers or reduction in price of goods or services, for example, or an extra add-on for a holiday or for whatever. I mean, it's up to the credit card provider, I guess, what those points can be used for. Now, something else here that's worth a mention is that an annual fee is usually charged by credit providers, even if the card is not used. So you could have a credit card account, don't even use it. There's usually an annual fee, so you need to keep that in mind. Extra fees and charges may apply, which need to be considered when choosing the best credit card for your circumstances. So there might be, a credit card where if you make, under a certain number of purchases, there's an extra fee. In other words, they're trying to encourage you to use the card. So if you make 10 or more purchases a month, then this extra fee is not added on. Or they might even waive the annual fee if you spend a certain amount using that credit card. Again, you just need to check the terms and conditions on whichever credit account that you wish to apply for. Okay. Now, just this last point here. When calculating the interest charged, the time is usually calculated from the date of purchase, okay, to the date of payment inclusive. You need to know what this word means. It means you've got to include, the start date and the end date. In other words, when you pay the credit card off, or you make a part payment, whatever, let's say you pay the credit card off, that date of payment is usually included, but not always. Okay, this is just the next page. So, for example, if an item is purchased on the 3rd of April using a credit card, and the repayment was made on the 10th of April, in the same month, of course, not a year later, this would amount to 10 minus 3, so that's 10th of April, minus the 3rd of April, but then you've got to add 1 to give you the total number of days of interest that's accrued. In fact, if you sort of count them out, 3, 4, 5, 6, 7, 8, 9, 10, right? There's 8 days, okay? So the easiest way to think about that is if you take the end date minus the start date plus 1 to include the extra day. That gives you the total amount of interest accrued. Now, if the question or the situation says that the date of payment is not included, then you don't have to worry about this plus 1 business. It'll just be 10 minus 3. So some credit card companies may not include the date of payment in the interest calculation. So in the above example, 3rd of April to the 10th of April would amount to 7 days of interest accrued, not the 8 days. Very, very important, very common mistake that is made. Not taking into account whether the payment date is included in the number of days of interest, the N, or whether included or not. So, in other words, read the question/problem carefully. So, generally, when answering questions involving credit card purchases, the first step is to convert the annual interest rate into a daily interest rate and then calculate the interest owed on each item from the date of purchase. So, it's one of those divide and conquer type things. Each of the items would need to be calculated separately because they're purchased on different days. You're going to have a different number of days of interest that is owed on each of those items. So they have to be worked out separately. Yes, there's a little bit of working out that you'll need to show. However, the good news is that the calculations are basically the same. All you're changing is the N part of the compound interest formula. Okay, remember FV equals PV 1 plus R to the power of N. It's the N that is of importance here. The R, constant, the same interest rate. Just number of days changes depending on when the items were purchased. Okay, so generally when answering questions involving credit card purchases, the first step is to convert the annual interest rate into a daily interest rate, because that's the norm. It's an interest that's compounded daily. And then you calculate the interest owed on each item from the date of purchase. You need to take into account the point made up here. Do you include the date of payment or not? So again, something else to consider. And then calculate the interest owed on each item from the date of purchase. Combine the subtotals into a final amount to determine the interest charges for that month or statement period. Then you just sort of gather it all together, add them all up, and there's your amount owing. Okay, that includes the principal and the interest. If it's if the question is asking for the interest only, then you would obviously need to subtract the principal. And the principal actually is the purchase amount. So in the next video, I'm going to end the video here, but in the next video, I'm going to go through this particular example. Okay, I'm going to sort of itemize it so you can see how, or at least one way that you can set this out effectively. Okay, thanks for watching.